All right. Hello, everybody. Today we are going to talk about quantitative easing or QE and how this is related to the Fed rate. So, if you have not watched my Fed rate video, don't understand how the Fed rate works, I'll give you a brief overview now, but you really should look into that whole video. So, basically, the federal funds rate is the overnight lending rate between banks, and the Federal Reserve Committee will raise or lower the overnight lending rate based on what they want the banks to do. So if they raise the rate, they want them to lend less and tighten monetary policy. And if they lower the rate, like they have been for the last 2 years since the start of COVID, now they've just barely started to raise it, they encourage lending. In doing so, they add money into the system. They lend out, the banks lend out more money in order to create more dollars in the actual system. Now, in addition to this, the Fed also started a process called quantitative easing or QE. So, quantitative easing is a form of unconventional monetary policy in which a central bank purchases longer term securities from the open market in order to increase the money supply and encourage lending and investment. Buying these securities adds new money into the economy and also serves to lower interest rates by bidding up fixed income securities. It also expands the central bank's balance sheet. So, what does this mean? So, QE, they are buying up U.S. Treasuries and mortgage-backed securities off the open market. So these banks hold treasuries and mortgage-backed securities, and they have those on their balance sheets. Now, in order to have more liquidity, the Fed comes in and says, hey, I'll buy that from you and give you the dollars you need to lend out more money. So the Fed comes in and they buy these treasuries off the open market, interfering with the market, pushing the price of treasuries way up by creating artificial demand, injecting more money into the banks so they can lend out more money. Now, they're also doing this with mortgage-backed securities, and this is what I wanted to really get into is so the Fed is creating its own little Ponzi scheme if you look at it kind of the way I see it. So, the Fed takes interest rates and they lower them to encourage banks to lend. So banks can now no longer get any yield by lending money in the short term to each other. So they're forced to lend out more money. In addition to that, a lot of the requirements for reserves were lifted and lowered, so the banks didn't need to hold as much money as they would have normally in order to encourage even more lending. So these banks lend out more money to people who want to buy homes, for instance. That's a big part of it. It's mortgage-backed securities. So let's look at their balance sheet actually before I get into this. So Fed liabilities, $8.9 trillion as of March 31st, 2022, included $4.6 trillion in deposits by banks and U.S. Treasury, $2.2 trillion in Federal Reserve notes, $2 million in repo agreements, which I'm not even going to get into those right now. That's a whole nother thing. I wanted to talk about uh, the loans that they're buying up. So here it is. So $2.72 trillion of the $9 trillion Fed balance sheet is these mortgage-backed securities. So mortgage-backed security is something the bank lends. So the bank is lending out money in order to finance the average Joe and Jane buying a house. They group all of these loans together in something called a mortgage-backed security. The cash flow from that mortgage-backed security is something that the banks have, and it's in this giant security with all these loans piled together to decrease the risk of it or increase it in the case of 2008, but we're not going to get into that either. So they're encouraging the lending of these banks by lowering the interest rate. Banks are in turn lending out way more money, which is driving up asset prices like crazy because now more people are eligible to buy homes at a lower interest rate. So more credit is available to them and they are able to buy more expensive things than they normally would be able to because of that low interest rate. And then the Fed is turning around and buying back those mortgage-backed securities that the banks have lent out to give the banks more liquidity so they can lend out more money to create more mortgage backed securities. All right. Still with me? Now, I know this is only a little piece of the Fed's balance sheet, but $2.72 trillion is no small amount of money. And I just want to take a step back and look at the Fed's balance sheet as a whole. So I think this is the chart from the Federal Reserve website, and I don't even think it won't even let you go back farther than 2008. And that's because it's you can't really see just how crazy the number is on this chart. It doesn't really pop out as much as it would if you were to see a chart of history, because it'd basically look like this: nothing, 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 nothing. Little blip in 2008, all the way up. So this is in that's $4 trillion. So it's in millions and millions of millions of dollars. So that's $4 trillion. Starts to dip down, and then COVID happens, and they buy up. This is what they buy up almost $9 trillion of assets off the open market. We're the United States. We're supposed to be a free market open system, and this is just me showing it's not. It's not. When you have the Fed coming into the open market and buying $9 trillion of assets off the bank's balance sheets in order to encourage them to lend out more money, you're not really in an open and free market. Now, I wanted to not only just highlight this to show how crazy it is, but now they're talking about reducing this number. So they're going to start selling this $9 trillion of assets they bought off the open market back onto the market. And you see what happened back in 2008, where they interfered and they started buying these mortgage backed securities, doing the same thing they did in 2020. And they just kept on buying them and kept on buying them. And by the time they got done buying them, it was 6 years later. They didn't do anything for a while, and then they just barely started to sell them off. And then the next financial crisis happened, COVID, where they forced everyone to stay in their homes and they shut down businesses and locked everyone inside. And then they had to start buying again, and now you couldn't just buy $4 trillion in assets. You had to go all the way up, and you had to double that and buy another $5 trillion almost in assets off the open market. So my point is, now we just extrapolate this out a little further. We think they're going to start selling here. Eventually, they're going to crash the markets from this interest rate hike that they're doing, and all of these T-bills that they're now just dumping onto the market. In addition to mortgage-backed securities, they're going to crash something, and then what's going to happen is it's going to start to come down, and then in order to save the markets, they're going to have to step in and buy it again. Now, they might not, but if they don't, they're risking the whole system imploding because no one's going to buy them, and then the banks are going to. I don't even know where that goes. I don't even know where that leads. All right, so now it's what are the implications of this? I'm gonna end off the video here. So the Fed at some point has to sell off these mortgage-backed securities and treasuries in order to help raise the interest rate. Question is, how much of them can they sell off before they have to lower the interest rate again? And if we go back and we look at what happened in 2008, it's not that much. They barely sold off a trillion of the almost 5 trillion they had then. To think we're going to make it much more this time would be to deny what happened in the past. I mean, I'm not saying it's impossible, but who knows? So sell these mortgage-backed securities and treasuries on the open market, decrease the money supply, raise interest rates, discourage lending, try and contract the economy. That is what is happening right now. And what is going to happen into the future until seemingly the Fed breaks something?